The market does not reward loyalty, it rewards attention to data. We are entering 2026, a period where the fundamental structure of the crypto market is shifting away from speculative narratives toward economic reality. Before we go any further, if you value data-driven, calm crypto analysis instead of hype, make sure you subscribe to this channel. This channel is built for people who want to understand the market, not chase noise. Many retail investors are currently walking into a trap. This trap is not a scam, nor is it a rug pull. It is a mathematical certainty driven by specific, observable data points, aggressive inflation schedules, massive token unlocks, and ecosystem stagnation. The revenue meta has emerged, where protocols without credible cash flows are punished by the market. Meanwhile, overleveraged tokenomics create a ceiling that price action simply cannot break. Based on the data, here are 10 assets where the structural headwinds are signaling a need for caution. First is Optimism. The data shows significant supply pressure. A scheduled unlock of over 31 million tokens occurred just prior to 2026, adding millions in sell pressure. Despite technical upgrades, OP dropped nearly 85% in 2025, significantly underperforming the sector due to this recurring dilution. Next is Arbitrum. We see a pattern of cliff unlocks. On January 16, 2026, over 92 million tokens are set to enter circulation. While it leads in total value locked, the price has suffered, dropping significantly in 2025 as the market struggles to absorb these scheduled supply shocks. Then we have SUI. While the technology is robust, the tokenomics present a hurdle. A major unlock of over 43 million tokens is scheduled for January 1st, 2026. With a fully diluted valuation often far exceeding its circulating market cap, consistent monthly emissions create a hidden tax on long-term holders. Fourth is Worldcoin. The data highlights a heavy linear unlock schedule. Reports indicate over 37 million tokens valued at over $100 million are entering circulation in single weekly windows. This level of supply expansion dilutes existing positions regardless of project adoption. Fifth is Polygon. The migration from Matic to Pol has left residual sell pressure. Despite network upgrades, the asset traded down 78% year over year by late 2025. The market has yet to decouple the price from this technical resistance and migration fatigue. Before I continue, if this type of evidence-based breakdown is useful to you, subscribe. Most people only hear this analysis after the cycle is already over. Next is Cosmos. The ecosystem is contracting. Data shows a 21% year-over-year drop in developer activity and the shutdown of key ecosystem projects. High inflation rates of up to 20% have historically eroded value, though a redesign is proposed for 2026. Seventh is Shiba Inu. The burn mechanism is mathematically insufficient against a 589 trillion supply. The token plummeted 66% in 2025, and momentum indicators like the money flow index show capital is leaving the asset rather than accumulating. Eighth is Dogecoin. Structural stagnation is the concern here. Development activity has been virtually non-existent for years. Furthermore, it relies on an infinite supply model issuing over 5 billion new tokens annually, requiring constant massive capital inflows just to maintain price. Ninth is Litecoin. While functional, the data indicates waning relevance. Search interest has hit multi-year lows, suggesting a lack of new retail capital. In recent cycles, it has consistently underperformed Bitcoin, delivering diminishing returns, from trough to peak. Finally, Aptos. Institutional locks remain a heavyweight. Over 32% of tokens remain locked until 2028. Despite technological milestones, the asset underperformed in 2025 with a year-to-date decline of nearly 67%, signaling that supply dynamics are overpowering the narrative. Why do investors hold these assets even when the data turns red? It is often unit bias or the sunk cost fallacy. Investors wait for all-time highs to return, ignoring that the circulating supply has changed. If the supply doubles, the market cap required to reach that old price also doubles. The market in 2026 is moving toward revenue generation and sustainable tokenomics. Do not let emotional attachment override the math. Assess your portfolio against the data, not the history. If this analysis helped you think more clearly, subscribe. This channel is about understanding the cycle before it becomes obvious.